Okay, great. Hello, everyone. My name is Michael Paulenoff. I am the editor and chief cook and bottle washer, I guess you'd say, for MPTrader.com. And as a matter of fact, in February of 2001, we started MP Trader. So it's pretty amazing. 20 years has gone by so fast, but it is what it is. And I'm glad I'm still standing, as it were. Lots of markets, lots of craziness, and I'll try to impart some of my experience and wisdom to you along the way. I use TradeStation, as you probably already noticed, and I'm opening my bond and interest rate platform where I have all my bond and interest rate charts. And I'm glad whoever wrote in TLT started off with that, because my perception of everything that's going on in the markets is either jaded or informed by my long-term view of 10-year Treasury yield. And after this loads, I'll show you that. In the meantime, this is what the website looks like, MPTrader.com. And if you click on room, all day long, starting very early in the day, myself as well as our members either converse with me on the platform, or converse with one another, or post their own comments, or post their own charts. And let's see if that was yesterday. I'll just show you the first entry I had today. So this was this morning. Good morning. I said we have earnings from Amazon and Google less than an hour from now, and then we have some economic data. And tomorrow we have jobs. Then I go through what my perception is of this post Powell pivot, even though he didn't probably intend it to be a pivot. It turned out to be a pivot. Anyway, I explain what I think is going on and where you can click on the chart and it enlarges it. And if in my work, above, this is the E-mini futures contract, the March contract above 4180, which was last seen on December 13th of last year. We had a CPI and a spike higher on that is a lower than expected CPI, but the market reversed in a big way. And to me, that was a seminal moment, a pivot point, above which my work turned from bearish to neutral, and which in fact happened today, although we haven't closed yet. Anyway, so as the day goes on, people write in, I put in more, you can see my picture, MJP, and I put in comments, stocks, and then I take requests, and on and on and on. And it's a running dialogue, as well as a running diary, from, I would say, Eastern time, about 7 o'clock, sometimes earlier, to 4 to 5 o'clock in the afternoon. And by that time, I'm basically good for nothing. And then I get some rest until I do it all over again the next day. In the meantime, reading as much as I can read, and blah, blah, blah. Okay, so that's MPTrader.com. And let's get back to TLT. All right, so here's the TLT. All right, so apart from the fact that you probably, if you've never seen my charts before, some of them I overlay all the data entries, critical data entries, like in the case of TLT, which is a reflection of the long end of the bond market, the Fed meetings, Fed minutes, economic data that could have an impact on the price action and so forth. So I overlay that, and the chart turns out to be a little busy, but after you get used to it, it sort of makes sense. So you can see where price is in relation to economic data and event risk, as it were. Okay, so as I look at this chart, and we'll expand it in a minute or so, what I see is in October, November, we had a major low, double bottom, as it were. And of course, no one knew what it would be then, except I had some ideas from my longer term yield charts that we were in an area, 450 in yield, where perhaps we could see a low in price, and that being the TLT. So anyway, the way I view this chart is that we have a 7-month period of accumulation, as it were, really from September to maybe even before to now. And here we are. This was yesterday, right here where my cursor is. And that was the FOMC meeting and press conference from yesterday, where the market apparently thinks that Powell caved to just an intense pressure by the market to lead the Fed. And you would never hear me say that the market is wrong, and I'm not going to say it now. The market, as far as I'm concerned, is always right. Of course, when you have algos and all sorts of strange, things happening, occasionally there's a short-term blip that reverses or corrects itself. But in general, the market is a reflection of mass psychology, and mass psychology on this chart is telling us they're accumulating bonds, interest rates are coming down. Now, that dark red line, horizontal line across the screen at, let's call it 110. If tomorrow's jobs data shows any inkling towards disinflation, either in the number of jobs added or in a real surprise, lost jobs, and coupled with some lower wage component, average hourly earnings on an annualized basis coming down from 4.6 to 4.3 or lower, that'll add more fuel to the fire that inflation is less of a problem and perhaps recession is more of a problem. Now, that combination is music to this chart's ears. So it's conceivable that tomorrow we take out 110 and my next target is 115 to 117.50. Now, on the other hand, if it comes in stronger than expected, let's say we have 250,000 or 300,000 additions to payrolls, if we break 103 on 105, that will be the first real big warning, and 103 will be the second warning that, oops, maybe the Powell pivot isn't really a pivot at all, and maybe there's a problem, and that Powell is just waiting for the market to blow itself out and say, okay, back to reality. We're going to some other, interest rates need to stay higher for longer, and the short end is slightly ahead of itself. Okay, anyway, that's the TLT. So right now, my bias is to the long side, unless it breaks like 105.30 around there. And then I have to think about what the market's telling us. Now, so this chart is the yield chart. 10-year yield goes back to the bear market low. Now, we had a 40-year bear market in yield from 1980 down to, which was up at like 15%. And I think I started my career right at the high in 1980-82. And here we are at 0.4% at the pandemic bear market low in yield, 0.4%. Since then, however, 10-year yield looks to me as though we finished an up leg, not a bull market in yield, but the first up leg in a bull market from 0.4% to 4.4%, let's call it. Now, the question is, what is this on the way down? Now, yield has come down from 4.4 to today's low is 3.3. And if unemployment tomorrow, it triggers an up move in the TLT, which by definition will trigger a down move in yield, then yield will break the 200-day moving average, which right now is at 335, let's call it. And then this green box and the brown box under it is about as far down as I expect yield to go. Optimally, I think it probably will stop somewhere between this gap in here, like 317. Maybe it gets to 307, 308. But in an acute situation, I think it could go down to the 280s, which in terms of this chart would be about a 38% Fibonacci retracement. Just so happens that in the past, when we've had these setups at the highs in yield, the highs in the legs in yield, that there's been a time frame, like a cycle that's proven itself or unveiled itself. And the next cycle turn was anywhere from the, January 24th to February 16th. So of course, we're right in the middle of that now, but yield looks like if it can't hold the 200-day, that it's the low in time will be closer to the 16th of February and probably closer to 3%. Now, what does that mean? Let me just expand this one more time and then we'll get to more questions. I want to show you my monthly yield chart. Come on. All right. So my monthly yield chart goes back. Well, there it is. I don't need to tell you how far it goes back because I'll expand it. And you can see how far it goes back. All right. So monthly yield goes back to, this chart goes back to May of 1984. And you can see the downtrend. You can see the low at 0.4% that we discussed. We can see a major downtrend trend line, that cuts through the price axis now, or when we were breaking to the upside at around 260. And we then took out the highs going back to 2012 at 320, 3.25. And here's that peak at 337 we discussed a few minutes ago. The pullback, the decline from 437 to 330 so far, that's what this is right here, this little blip. Now, if this chart holds true to traditional form, then this pullback is a correction after this first up leg. And wherever it exhausts itself, there's going to be a second up leg in yield, in a new bull market in yield that's going to rip. I don't know what the world is going to look like. We can back into that as time goes on, but I don't know whether the low is going to be 320, 280, or at an extreme, it retests the extension of this this former resistance line, 230. I don't know, but right now, momentum on the monthly is still pointed down, and there's still some territory for 10-year yield to drop, which also tells me there's territory for the up move in the TLT. And I'll leave it there because other people have questions. So we'll go to DVN. Oh boy. All right, let's get into, let me load my energy charts, so it appears somewhat obvious, I think, that all the market had to do was fire the starting gun for technology with perception that rates were going to come down, So technology's gone bananas on the upside, and what has taken the brunt of the hit, of course, is energy. Now, so there are various ways to look at energy right now. One is that if the bond market is telling us that a soft landing, is unlikely, and maybe it's going to be a harder landing than that, well, energy demand, there's going to be demand destruction by the economy. In addition to that, you have, what are the forces that are trying to reduce demand? Well, OPEC's trying to reduce demand. The administration has tried to reduce demand in their own sort of strange way. But chances are, if there's a perception that there's a recession going on, that reducing the number of barrels produced will not compensate for perception that the economy is going to slow, because we don't know how slow it will be. Just the lag effect of 450 basis points of interest rate hikes in 12 months, that's never happened before. So at least in the modern economy, so we don't know what the lag effect will be, or the impact, how bad the impact will be. On the other hand, you have China. And for the last 2 weeks, for the most part, all we hear is that China's reopening and how great it is for everything and everyone. Yet the energy market can't get out of its own way. Sorry it takes so long to load. When we do these Zoom setups, it seems like Zoom slows down the whole process. But anyway, they're coming. In the meantime, so just as a sidelight, years ago I had done a study on RSI, and I came to the conclusion based on the study that the most sensitive period was 11 rather than the canned 114. So that's why I use 11 rather than 14. So back to China. So China is supposed to open and supposed to demand maybe 1 million barrels a day more than is in demand now. But the perception of China versus the perception of a recession seem to be unequal right now, and that the recessionistas, as they were, are winning the day. Now, of course, the wild card could be Russia and the war in Ukraine, and we don't know how that will play out. So the risk, I think, is that maybe oil has, at $70, has $10 of risk in it, and 40 to 50 on the upside. The question is, do you stick with Devon and Halliburton? In my mind, you do. Of course, everyone has their stop level, and that's a different issue. Risk management, personal risk management is different. But in terms of the perception of Devon and Hal, mine is that these companies are going to make money and continue to make money even at $60 a barrel, and that it won't stay there. Now, if we're talking about 10 years from now, I suspect that the fossil fuel industry will look very different in 10 years. But for the next 18 to 24 months, my sense is that there's going to be a lot of volatility in fossil fuels, and we're coming from a multi-month period where we've had relentless decline from 120, 130 down to 70, 75. And I think we're closer to the end of this move than the middle. And if these charts would hurry up, we'll look at Devon and Hal. Come on. So as they load, you can see the charts that I keep in the. I mean, that's probably one of the reasons is this particular energy sector loads so slowly is because probably I have way too many charts in the background. But that's neither here nor there. We are in the middle of loading these things now. So anyway, while we're talking about energy, so Exxon came out with, blowout earnings and the whole 9 yards. I guess it was 2 days ago or yesterday morning. It was one day in the last couple of days. And so Exxon spiked to a new high for the move and then has come back sharply. It seems to me that come on, that Exxon is setting up another buy for another upleg. And if the chart loads, I'd be happy to share it with you. Let's see here. Let's put Devin in here. I'm going to use another screen on another format so I can start talking about it. And then we'll look at it. So just bear with me 1 second. All right, here we go. All right, Devin. So I'm going to talk about Devin while the charts load, so we can. And I'm going to use a different computer that I have access to for a different kind of work. But anyway, Devin. So Devin is sitting right around $60 right now. If you look at Devin from an intermediate term perspective, so it hit a low of $5, believe it or not, in March of 2020 at the pandemic low, and then proceeded to go up to 80. And that 80 high was roughly June of 22, 6 months ago, 7 months ago. So for 7 months, Devin has traversed a range from 80 to 50, back to 78 or so, back down to 56, 57, then most recently up to 65, 66, and back down to 60. And that's where it is now. To me, when you look at the big picture from the pandemic low, the move from 5 to 80 is a completed up leg, followed by a sideways digestion period for 7 months so far. To me, this is a bullish digestion period unless Devin breaks $50, $48. Then the digestion period becomes a top. In fact, I would say this, that if Devin breaks 56.5, that will be the first warning sign that instead of a sideways digestion period, Devin actually is looking more toppy, but the confirmation of the top will be a break of about $48. For me, as long as at least 56 contains any additional weakness, I am looking for Devin. It may come down to 58 again. And if it does and turns up, I'm looking for Devin to take off from the completion of that digestion period from June of 22 and to take off and to make new highs. That would mean that Devin would go to somewhere from 55 to 60 on a low to 85 to 90 at the high. And that's the way it looks to me from Devin. Halliburton. It's unbelievable how long it's taken these charts to. Well, all right. So from my other chart package on a different computer. So similar to Devin, as you might imagine, because Hal is also in the energy sector, it hit a low of under $5, maybe $4.60 back in March of 2020. So it went from under 5 to a high of about 44, and that occurred in June of 22 also. Now, to me, this is a different pattern after the June of 22 high, a different pattern in Hal than we saw in Devin. So Devon just got slammed from June into the end of September down to $23. So it went from 44 and change down to 23 and change. And since then, looks to me as though Devon has started a new bull phase. The first high of which occurred last week at around 40. What is that? Around 43 and change. Now what Devon is doing, now what Hal is doing is pulling back, and I don't expect it to pull back lower than $36, after which I think it'll embark on another up leg to new highs above 44. And I wouldn't be surprised to see it hit 48 to 50. Let's see what else. What time is it? Okay, so we have after the close today, we have Amazon and we have Google. Now the two of those could take the NASDAQ up, with the QQQs up even higher. And my next target for the Qs 313 to 317. So and the Qs are trading at 310, 19, 20 at the moment. So I'm looking at that as another catalyst for this crazy, fantastic move in the big techs. And let's see if I can switch pages here. Can't switch pages either. Wow, what a shame. Well, so anyone else have any questions? Like in terms of the spider, so in terms of the spider, as long as the spies sustain above 409.70 or so, I'm thinking the spies are going to the next target is going to be 420 to 422. And if it takes that out, I think we're going to 430 to 432. And if that's the case, I have to believe that tomorrow's economic data will be market bullish. In other words, the data will be weak. It'll be our first inkling that Powell's perception that higher for longer is not the right one. It'll vindicate the short-term treasury market that says no way Fed funds gets to even 5%, that they're done. And the other day on CNBC, Rick Santelli was saying that he thought that we would look back on this hike as the final one. And if tomorrow's data are weak, then I think that he'll end up being correct, that it'll be the final one for a while. And I guess Professor Jeremy Siegel will do his victory laps. He's been screaming that Fed funds or short-term rates are going to be inflation will be back at 2% before long, which is hard for me to believe. I think probably now that what we discussed earlier about the monthly bond yield chart is telling me that the next up move in bond yields after we get a pullback to wherever 330, 320, 280 will be above 4.5, pretty much 5.25 or higher. What the world will look like then, I don't know, but Either inflation is going to rear its ugly head, growth is going to rear its wonderful head. There's going to be some sort of crisis, or there'll be some sort of crisis with the full faith and credit of the U.S. Treasury, in that this won't be your run-of-the-mill 12th hour decision to raise the debt limit. Somehow there'll be a loss of confidence that will create a plunge, an exodus from the dollar that will rip bonds to the upside. And that scenario I don't think is out of this world, believe it or not. I really don't think, not with $32 trillion of debt. And China, Russia, Iran, India, North Korea, all conspiring to do transactions outside of the dollar currency. And slowly but surely, maybe more rapidly than we think, they're creating a competitor to King Dollar. And it's not in the best interest of the dollar to have that happen. Okay, GLD. So I guess my discussion of the dollar also could pique your interest in the GLD. Now, the dollar index bounced today from about 100 to 101 and high change. And my work on the dollar, and if these charts ever load, I could show you my work on the dollar, but my work on the dollar argues that for the first time, we're having a momentum non-confirmation on the downside from the dollar's peak at 114 and change late last year, to 100. And that's the first indication that this down move of 15% is exhausted. And if that's the case, we're going to get a bounce in the dollar. The question is the magnitude of the bounce. Right now, on a short-term basis, unless dollar index DXY can climb above 102.50 to 102.75, the initial resistance, from where it will go to 106, if it can get over the 102.50 to 75 area, then I think we have an up move in the dollar that will be detrimental to GLD and the miners and the metals in general. So, but there are two ways to look at this. One is that the fact that there's a non-confirmation is a warning, and GLD was down for a reason today, and that I think is part of the warning. However, if you want confirmation that the GLD, this up move from 150 to 182 or so, is complete, I think you need to wait to see if the dollar can climb above 102.50 to 102.75 to get confirmation. If we're just looking at the GLD and you say to yourself, where do I stop myself out, or where do I have that line in the sand to make a decision? 106.90 is the place where I would put that line in the sand, and right now we're at 177.96. So about $1 under here. Well, not really. About $2 under here is where I would have my line in the sand, and that I would attach to where the dollar index is, depending on where it's trading, whether or not it's above 102.50 to 102.75. So the two things are sort of attached. On the other hand, if you don't want to wait around for that morning where GLD gaps down because the dollar is gapped up for whatever reason, then you should probably get out of half your position here. And tomorrow, if there's weakness in the jobs data, the dollar should go back down, dollar index, and GLD should go back up. The question is whether or not the dollar takes out its 100 and change low, and whether the GLD takes out its high. And if there's weak data tomorrow and the bond market reacts very favorably to it, but the dollar seems to be stuck around 100 or higher, and GLD is stuck under 180, my sense will be that those markets are exhausted. In other words, the GLD upleg from 150 to 182 is exhausted and needs a rest, and the dollar index needs a rest also, in the form of a rally. So that's the way I would view that. And so if the TLTs take off and they're above 110 and there's no corresponding directional moves in the dollar and the gold, then I think those markets are telling us that they're tired and they need a rest. And there'll be a pullback in GLD. Where would that pullback? I think the pullback to 170, 168 would be the next buying opportunity in the GLD. It's unbelievable that this program, if I could abort it, doesn't even respond. Unbelievable. Well, my apologies to everyone. Yeah. So let's see what Meta is with 20 minutes left in the session. What a shame. I had so many great charts to show you. As you can tell, I have many. How great they are, you'd have to decide, but holy cow, it'd take long to. And I wanted to show you futures. Oh, what is this now? All right, come on, get rid of this thing. Let's see what's going on the website. What people are writing about here. MP Trader. Oh, well, I signed off, and everybody is quiet. Here's the VIX. This was my last entry on the VIX, and you can see the VIX. The VIX was going up this afternoon while the market was going down, and then the market had a bit of a dip, confirming the VIX. If the VIX closes above 1915 and or chews through this resistance area between 1915 and 20 and a quarter, then I think we will have a confirmed low in the VIX. And this would not be a good sign for the market. It would tell us that, in fact, fear is back and that people want protection because they think the market has gotten ahead of itself, the stock market, the cash S&P, or for whatever reason. But this down move from the September, October highs looks like it's complete. Although I expected today's action, usually when you're in a bull move in the S&P, the VIX intra-week, if the S&P is strong, it usually means the VIX is going to press lower into Friday's close. So I was expecting this morning that the VIX would roll over from under this 1915 level and hit a new low tomorrow, with the market, with the S&P making new highs for the move, maybe perhaps in reaction to the the jobs report. So that's still on the table, but after today's up move late in the day in the VIX, something fishy is going on. So we have to keep that in our minds. Let's see. So I had looked earlier in the day at Cathie Wood ARK fund, which really has taken it on the chin. Obviously, it was down 82% from its all-time high. Where was that? I don't know. I have to go back and look at the chart, but let's see. these charts ready yet. But anyway, Kathy Woods, this looks like a potential base, big base pattern. And of course, she's here are her positions. Her biggest position in Tesla, and Tesla has had quite the run from 100 to 195 in just a couple of weeks. So so a lot of these stocks that she's in finally blasted off. And based on this, the way the pattern has unfolded, if it can get through 46.30, I think the next move is to 53.50 to 53. And that's where we're going to separate the wheat from the chaff, as they say, in ARK. Because if ever ARK trades above 54, this will be a massive base that is 7-8 months in the making, and it will have staying power. And I guess so will she, after having a 2-year, just terrible 2-year period. So I had mentioned earlier that tomorrow we could be headed for a quadruple bagger. Well, first we had the Fed, then we had bullish Meta. Tonight we have Amazon and Google if they follow suit, and maybe we'll have the first deflationary data point from the labor market tomorrow. And those are the 4 things that could really lead to some serious further upside in the markets. Let's see. So this is a chart of the E-mini S&P and March futures, minis that is. And so you see the breakout today. It went higher than this. This was from earlier this morning, but we took out the trend line that goes all the way back to the January highs. Now it's starting to look, and before it broke above the trend line, and before it took out the December 13th high, it looked like another powerful recovery rally in a bear market, all defined beneath this trend line that goes back to like January 4th, 2022. That changed yesterday and today. Now it's morphed itself more into a base than a recovery rally. And that base could have very serious upside. However, I have to give the benefit of the doubt that it's still some sort of recovery rally, albeit a big one, where you get equidistant moves. Would be the October-December move. Then you had an intervening pullback, and that the equidistant move would take you up into, the 43.50, 44.50 area. And then right when everybody is super bullish, it tanks again for whatever reason. Now, if I juxtapose this scenario that I just went through with my 40-year yield chart, I can come to the conclusion that if yield pivots off of, for argument's sake, 3.10% and heads higher with a vengeance for whatever reason, you can see how this period would end up, we'd look back at it as a bear market rally, and it would be due south thereafter. But right now, this is what we have. We have all these highs through here that we took out today. I don't know if we're going to close above them, but tomorrow would be the key day, Friday, after the jobs report, the end of the week on a Friday close, ahead of the weekend. Who wants to be long? Who wants to dump the stocks that aren't performing? Who wants to get in to the FOMO trade, fear of missing out on the technology run. All these questions, if they haven't been answered yet, institutional investors are going to have to answer them tomorrow if the market is on the move on the upside. Okay, one more time. Let's see if great. Well, once again, I am eternally sorry that next time I do this, David, I will make sure that I have, let's say, just 20 charts on one page, load it once at the beginning of the webinar, and we'll go from there.
Yeah, I understand it. It happens. There's always going to be some tech issues. Would you be able to just like bring up stock charts on your computer and use that, temporarily? I'm sure it doesn't have all your, everything you usually look at, but or I could share my screen and just bring up the charts.
Let's see
the symbols you want to look at.
Hang on. That was a good idea that I should have thought of before too. So let's you see the 2-year yield chart?
No, I just see a bunch of stuff like it's trying to load still.
Oh, boy.
You might. Did you switch over to your browser, those stock charts or something?
Yeah, I did.
Oh, okay. Yeah, you might have to stop your share. Here, let me do that for you. Okay, now try resharing the stock chart screen.
You see my 2-year chart?
Yeah. Yeah, I see it now.
Okay. So let's take a look at you see point and figure Apple.
Yeah.
Okay, so let's just look at one energy point and figure chart. So you can see the XOP, which is the exploration side of the energy sector, has been in a sideways move also since June, and it's on a minor sell signal here, but nothing really. If I put in Halliburton, so this is Halliburton from a big picture perspective, and it certainly doesn't look great at the moment, but it's pulling back and into this 35 area. That's the key level for me and Halliburton. Just see what happened with these other charts. I have all these annotations on here. Oh. All right, well, you can see all the well, maybe it's finally wow. Do you see, David, do you see the charts filling in on?
No, we're still seeing Halliburton.
Oh, you are?
You'd have to stop your share again and switch back.
Okay.
Do you want me to do that?
Yeah, please.
Okay. Yeah, you should be able to do a new share now.
it's like it was clogged, and all of a sudden it freed up. They all came. So see that
It's loading. Okay, yeah, now.
March crude oil.
Yeah.
Okay, good. All right. Well, anyway, so this is my 4-hour chart of March crude. You can see that it tried numerous times for the past 2 months to try to get through $82, $83, couldn't do it. And now it's fighting for its life along this trend line at 75. If it breaks 75 for whatever reason, then we'll be back at 70. And that will be a tricky place for crude oil. Let me see. Now it's frozen on the crude oil chart. Come on. So David, when can I do this again?
Check my.
Any blue boxes available?
Yeah. Yeah. The next one is. I got a couple spots open on 2 weeks on the 16th.
Oh yeah, let's do that. Because what I'll do is I'll rearrange my charts to make sure this doesn't happen, and they'll load fast, and it'll be much better.
Okay. Yeah, that sounds good.
All right. So February 16th.
I'll send you
folks. Well, folks, I'm sorry, but looks like I'm totally frozen now in this chart. And why don't I just leave it there?
Yeah, we can stop here. So all right.
If you